Stephanie, do you want to introduce him?
Yep. Good afternoon, everybody. How are we? So today is Wednesday, right? The wonderful Wednesday. And so thank you guys for joining. I want to give a special introduction and welcome to Jojo, who is our in-house lender over at Calabasas for House America Financial. And he's going to be sharing with you a lot of information. And please feel free to ask any questions in the chat box. He has a PowerPoint presentation that he'll be going through with you, but just really explaining the different programs, etc., that they have to offer right now. So a lot of great stuff. So anyway, without any further ado, here is Jojo.
Good afternoon, everybody. What we're going to do today is basically go over a short introduction about House America Financial, who they are, what they've done, very short. But the bulk of it is really a market update and a recap of what's going on in the market and how it impacts your business, interest rates, stock market, so forth and so on. And then at the end, maybe 20 minutes, 15 minutes prior to the closing of our meeting, we'll open it up for question and answers for everybody. Okay, so I'm going to get started. Let me just share my screen. Did everybody see the screen? I guess we're not going to get a response.
There, I have it on Facebook.
Can you see it, Stephanie?
Yes, now we can see it.
Okay, awesome. Let me start this thing there. Okay, so as Stephanie said, I come from House America Financial, the in-house lender here in Calabasas. I've got years and years, over 20 years of background in lending, mortgage banking, and retail banking per se. I worked in the biggest banks that you might have heard of, Citibank, Chase, so forth, and in mortgage banking also. So I have a lot of information I can give you and share with you, but we're going to recap some of it today. By the way, we're moving. This is our new office to start to show you in La Cañada. It'd be nice. Feel free to come by anytime if you're in the area. Okay, so who are we? I'm not going to go through each one of these lists, but I kind of want to share with you the core ideas of the company. And they really are a concierge company per se, as far as helping agents and helping your clients, your buyers and your sellers. Although it is a smaller company in size as compared to United Wholesale Mortgage or Chase or Citi or B of A, they can deliver their product amazingly well with very smooth transition because they're designed to have low amounts of loan officers but high volume, and the whole infrastructure is designed to help each loan officer really provide excellent service and an amazing client experience. So just to show you, United Wholesale Mortgage is one of the biggest lenders today in the country, followed by Wells, B of A, Quicken, and Chase. And we are at the 15 for a small independently owned company, and I don't mean small per se, but it is not nowhere as big as those top 5. We ranked 15 in volume for last year of 2019, and most of those fundings actually are in the purchase side, which you'll see in the next slide. Oh, maybe not. Let me see. Yeah. Okay, maybe not. So I'll start with what is going on today in the equities market. This was as of this morning. The Dow DJIA is up 26,000 since the start of COVID, which was around 18,000 points. It is in this morning, it was down 23, but it's up now, I believe, in the positive, in the green, about maybe 40, 100 points. What is the point of this information? So this continuous uptick in the market is helping our interest rate. You'll see in the second slide where the rates are. But each time that we have a movement in the equities market, it impacts on what happens to interest rates, either up or down. For example, look at the market, look at the interest rate forecast for the last 90 days. In around April, around March, we were around 3.5, 3.2. But this morning when I checked rates, it was actually touching the 2.8 for 30 years fix. And according to the economists and all the wizards, we're going to stay at that trend, maybe even a little lower, depending on where. If we have a continuous rally in the market, it's going to continue to press down and keep our rates low and lower. So, okay. You want me to stop and ask questions?
No,
No?
we'll let you know. I don't see.
Okay.
Just remind people if.
Yeah, anytime, guys, this is very conversational. Just ask away. A lot of this information is really just for you to have talking points to your clients as to why. Clients always ask, what's going on with the rate? What's going on with the market? Well, here are good talking points that you can jot down today and really add credibility to your the conversations that you have with potential clients and existing clients. The summary of this particular slide is showing us that we will continue to have low rates, lowest it's ever been, 2.8, 2.9. It's amazingly practically free money. We forecast this all the way to September and maybe even longer. We might have a slight increase right around November during the elections, because typically the adverse to this low rates is inflation. Presidents don't like high inflation when they're about to get reelected or they're running for office. So they tend to work towards lowering the inflation. It has an adverse effect on rates. It'll come up a little bit, but it'll still be in the threes. So feel free to tell all your clients, gosh, between now and December, we're really almost getting free money to buy a home. Think about car loans. Maybe a year ago, they were at 5% for car loans, 4%. And now this is a mortgage at 3%. Again, almost free money. Okay? Okay, let me move this thing real quick. What is going on? There you go. In the overall lending environment in the nation. So back in March when COVID started, there was a lot of panic. For example, I'm going to go down the bottom called the non-QM loans. They went away completely in the beginning, right after the first week of COVID. Non-QM loans are those private investor-driven fundings that allow, for example, 12-month bank statements, which I'll explain in a second. Well, this one you'll understand. We practically had stated income loans for the last year that were classified under non-QM loans. One of the derivatives of those stated income loans is called the 12 months bank statements, in which you would use a client's 12 months bank statements average deposits as their income if they cannot show income on tax returns or W-2s, because they're either self-employed, they own a business, they're doctors, lawyers, what have you. But as of, last week, 2 weeks ago, the non-QM loan products have started to come back in the market. As a matter of fact, we have 2 of them already in play today, fully functional. Rates are around 6% to 7%, depending on your scenario. But again, that product will allow a completely self-employed client who does not show traditional income in tax returns to be able to qualify for a loan. Now, granted, it will ask for a high down payment. When I say high, 20% is typical. But you will find that for those type of clients, 20% is not unheard of, because they know, they have an understanding, and they usually have money or equity in a sale of a home to purchase a new home with 20% down. But the top 3 of this slide. So at the start of COVID, I don't know if you might have heard people, I think we did a COVID disclosure telling buyers and sellers that, hey, we may not be able to close on time for many reasons. And one of them is being the lending side of it. And it really was horrific. Underwriting timelines were around 7 to 10 days. Appraisal was 7 to 14 days. Processing itself to even get a file into an underwriting status was around 5 to 7 days. So needless to say, a lot of delays during the start and in the middle of COVID. Primarily driven by employees not being able to come to work, employees losing jobs, so forth and so on. But as of this week and last week, those turn times are no longer the case. In our company, we have 24-hour to 48-hour turnaround in underwriting and getting approval. Loan docs in 1 day or same day. Processing is about 2 to 3 days to get it into underwriting. Appraisal has calmed down 3 to 5 days versus 7 to 14. So as you can see, the market has slowly come back to normal as far as lending is concerned. Item number 2 on the slide, though, it's called the lending overlays. So if you remember 2008, when the market was crashing, this language, lending overlays, was started back then because in the beginning of that market crash, a lot of the banks and lenders decided to minimize their risk. They would add their own guidelines or policies behind loans. Besides what Fannie Mae and Freddie Mac was asking, banks like Chase, Citi, B of A was pretty big on it. They would add additional restrictions on qualifying for a loan, and they were called lending overlays to really, really minimize the risk because nobody wants a default on mortgage loans. It's like the worst thing that can happen. So in the beginning of COVID, a lot of lending overlays happened, and a lot of people who were in process all of a sudden found themselves not qualifying. There were additional restrictions such as verifying their employment at the day of closing, verifying continued employment at the day of closing, which is unheard of. So, but in the last, again, 2 weeks or so, a lot of those additional restrictions are being removed or have been removed. So what is the message? It's trying to come back to normal as far as the lending environment is concerned. The third one is important for all of you who are about to go into a purchase because our interest rate is so dynamic. It moves literally every day from anywhere from an eighth to half a point, depending on what the stock market or the equities market is doing. But during COVID, when you started a file, there was no way you could protect the interest rate that you quoted to the client because they wouldn't allow for a forward rate lock. What that is like on day 1 or day 2 of submission, you can actually, typically without COVID, you can go in there and request to lock that rate in for 30 days or 45 days and protect it from market hazard. Meaning no matter what the market is doing, you are able to lock in your 3% rate and you were good to go till you close. They stopped doing that during COVID. They wouldn't let you lock until you have full approval because they didn't want to give commitments to any loans unless they know that it was going to get approved. That's no longer the case. So we're back to normal. And by the way, because the market today is low and volatile, if you get into a transaction, whatever lender or loan officer you're using, I suggest you ask them, hey, how quickly can we lock in this rate? That's a good talking point for you. Protects your client, protects your transaction, and ultimately delivers what you committed to the client, which makes for a good client experience. So this slide, although I talked a lot, was very important because that's really what's happening today. But
There's a question.
there is a question.
So what's the lowest conventional down payment percentage you offer, i.e. 3% down, 5% down?
Okay, so thank God those products never really went away. So we still have the conventional 97, that's 3% down. The FHA loan program never went away, which is 3.5%. What's the difference, Jojo, between the two? Well, obviously 3% is lower than 3.5%, but on the FHA, one of the benefits of FHA allows for more debt to qualify, meaning your debt to income ratio maximum is at 49%. Conventional 97 with a 3% down is at 45%. So if you have a client that's more debt saddled, or they're trying to buy a bigger home, bigger purchase price, and more bigger payment, the FHA might be an option. Otherwise, they're almost the same kind of product, designed to help people with either no or lower down payment. Does that answer the question?
Mm-hmm.
Thanks, Stephanie. You do keep doing that for me. Awesome. Next slide. Next slide. What happened? Next slide. Uh-oh. Stephanie, what happened? Malfunction.
Okay, hold on.
There, got it. Thank you.
Got it?
Yeah. This is a slide or information that's probably near and dear to the Keller Williams agents, and if not all, most of the office, because it is the jumbo loans. As you saw from this morning's presentation from many, average prices in most of the offices are 800,000 and above, especially the ones in the beach areas and the ones in the Wilshire corridor. We know this to be true. Calabasas for sure. So if you're going to touch the jumbo loan category, which we do here in Keller Williams, here's what's going on in House America Financial, because I brought this up because they are actually delegated to underwrite directly these jumbo loans. What does that mean, Jojo? So if you are delegated to underwrite loans, it means that your underwriter, the people that decide whether you're going to get this loan or not, are either in the same building that we are in or in another building, in this case in Florida, but they work for the company. So what does that mean without getting in compliance problem? Meaning they are, how would I say, slightly motivated to help us make sure that our deals happen. And not only that, it's convenient for timeliness and execution. So for example, the three main lenders that we use are Chase, PenFed, and Bank United. The pricing is very competitive. It is almost as close as the big banks like B of A and Chase, for example. For CIT, it's a nice product. They're definitely very competitive, although they're not directly in-house right now, but their pricing is good. So what does that all mean to you? In other words, these four lenders can service our needs for jumbo loans all day long and be able to compete with the market in case a client is trying to shop or trying to look around. Because why do you want to take it to House America Financial? Convenience, control, and accountability. That means I'm accountable to this lady over here to my right. I'm accountable to a guy named Manny Tias in Long Beach. I'm accountable to Forward Living. And so that goes down the line in my company. So you can take that to the bank for sure. The third item here is we can close in 30 days in jumbo. Some people today are saying mortgage brokers, smaller mortgage bank don't even have jumbo products. And if they did, they're typically not in-house or delegated. They have to broker it to another company or another big lender, which means they probably cannot close in 30 days. They're probably somewhere in 45 days or so. But with us, we can do it in 30 days or less. I didn't put or less there because I don't want you guys holding us accountable to that. But we can. Wells Fargo is a big jumbo lender, we were formerly delegated to them, but they're kind of stopped that right now. But again, after more relaxation on the COVID problem, Wells Fargo would come back out and delegate us again on that business because it's a big business for them. They actually prefer the jumbo product. Any questions?
We do have a question. Does your company offer the 203K rehabilitation?
Absolutely. The 203K rehab, meaning that you can borrow 96.5% of the value as a first mortgage, and then an additional 3 to 5%, I believe, I'm not getting my percentage wrong, to rehab the property, because maybe you're buying a slightly distressed property or a property that's not almost, move-in condition. Obviously, you cannot use it to buy a pool or add another layer of rooftop on it. Nothing for, it's only for necessary repairs or rehabilitation on the house. And yes, it is available. Rates are competitive. Call me, text me, email me, and I'll give you some pricing on that. Good stuff? Okay, next slide. Running out. Okay. What can we do for you at House America? This is the part where this is my sales pitch. Okay. So now there's two of us in the office in Calabasas, Brian and myself. Brian couldn't join us today. He had another commitment, but hopefully he saw this slide so he understands the value of what the message we're trying to share with you today. Because there's two of us, there should be no reason that we cannot capture as many pre-approvals that you could throw upon us. Remember on my first slide when I said House America Financial is a concierge lender? I'll give you an example. We all have assistants assigned to us for the main purpose of servicing the agents and the buyers and borrowers, and then someone else in the back end supporting us doing the paperwork and follow-ups and so forth. That in itself is big because instead of me spending my first morning, half of the morning following up on files existing, I can always be in front of you, in front of your clients, doing those pre-approvals as many times as you need them. Now, I touched upon this earlier, the in-house underwriter. It is really giving us or allows us tremendous control on the files, which leads to always on-time closings. Our closing execution record is pretty good. Minimal challenges because the underwriter could be literally right where Stephanie is sitting right now, and I can walk up to her in La Cañada and say, hey, this problem came up. What do you think? So I can get a direct answer, whether in person, on the phone, or email, versus if you don't have an underwriter in-house, I have to either call the main office, the corporate office, or the underwriting offices of the underwriters for that particular lender. We have them in-house. But again, it's all leading toward excellent client experience for you and your buyers. Can we close 30 days? Absolutely. Um, it can be as little as 10 to 15 days. Do we like them all the time? No, we try to be more diligent about it. But if it's needed, I make one phone call to my sales manager in La Cañada. I said, I've got a file that they want to close in 15 days. Can we do it? Can we prioritize? It is available to us. And again, because processing and underwriting is in-house and we are direct lender, we have our own money, giving us a lot of control with time. Any questions so far? Okay, good. Between Brian and I, we got 40 years of combined experience. As you can tell from my face, I've been doing this since I was 10. So, so between the two of us, we've got a lot of resources and information for stop talking, for your high quality to provide you high quality cross qualifications. You might say, Jojo, are we still doing that in the market? Absolutely. I get them all the time. Either it's requested from me or it's requested by me on behalf of a realtor and an agent that I'm representing. It is very important, guys, especially today that we're still kind of in COVID. Get those cross qualifications done. If you are looking at an offer, and I'm going to teach a class in the next week or two on reviewing offers with the financing documentation behind it. And once you're looking at it, especially if you don't have a lot of exposure in the lending world, cross qualification might be the second best bet to really know that your buyer can deliver. Not only deliver the loan, but deliver the timeliness on your escrow date. So these are the four main things that we touched upon today that we can do for you. I'm sure there's more with Brian. I'm sure there's a lot more, but this is the main ones that I want to stress upon today. Do I have another slide? Oh, looks like I'm done earlier. So this is me. I'm here based in Keller Williams, Calabasas, but that's supposedly my address in La Cañada. I welcome all calls and text messages and emails. I answer them till 10 o'clock at night. Ask Stephanie. She texts me sometimes, wait, sometimes for questions, but I'm here. Love to hear from you. Please.
Okay, she says, so for Angela, she said, weird question. In Monterey Park, comparables are going between $550 and $750 up to
Yes.
4-bedroom, 2-bath.
Right.
I can tell an investor purchased at the $550 increases square footage from 963 to 2,000. And the bedrooms to 5 beds and 5 baths, and now have it listed for $899. In their remarks, they say the den can be utilized as the 5th bedroom. How would a lender look at that?
Okay, so the den is part of the house. That's acceptable because we're not touching any ADUs. I don't know if you're familiar. ADUs, additional, what is it, Stephanie? ADUs? The
Accessory dwelling.
Thank you. See, that's why she's the boss. It's not touching any of that on the outside or additional addition. It's inside, so it should be fine. My only question is when the underwriting comes, if they are going to use it for another bedroom, obviously it has to. And I'm not the expert in appraisal, but if it's a den now, I believe to be considered a bedroom, it has to have walls and a closet at a minimum, but I'm not 100% sure. But the short answer is yes, it can be. Hope that answers the question. Any more?
I do not see any more questions.
Okay. Well, that really was the last piece of my slides. So now it's just, I did it pretty fast. I hope I didn't do it too fast. I've got plenty of time to answer any additional questions, anything that you want to know in this business. By the way, I'm a licensed real estate broker, so I've also done the real estate business for a long time. Stephanie and I used to work together at the C brand. But yeah, please, I'll stand here for as long as you need me to.
So, Asa, what are you mainly seeing in today's market? So, what are there some questions that you're getting asked continuously? A certain something that's popping up a lot, like Brian even mentioned something about appraisals today. Are we seeing appraisal issues? What are your thoughts and comments on appraisals?
So I have not personally seen a lot of appraisal issues, but Brian touches a lot of jumbo loan products, so that could be a whole different market and a whole different set of issues. I've done a lot of high balance, a lot of government, and anything over like $1 million and below. I've touched a lot of those. The short answer is no, I have not. The issues that I do see mostly today Right now, the prevalent issue is the job, employment, current employment, and continuation of employment, and then that verification at the end. At the end of every transaction, guys, today it's still an existing overlay. It's called a verbal verification of employment, BVOE, at the day before you're supposed to close. It is required, it is non-negotiable, and if they cannot call somebody on the phone to verify that Mr. Joe Smith is still employed in that company, they will hold funding. So when you're dealing with your clients, I guess the takeaway on that is when you have a potential buyer, today I'm telling my agents that I work with, please ask them, are you still employed? How good is the probability of continued employment? Because if it's not, if there's any hesitation, if there's any doubt, it's going to impact your transaction, maybe not even close. I've had some of that happen in the last 2 months in the company. So that's really the prevalent issue. Rates, God, no, it's free money. Underwriting, well, during COVID, like I said earlier, it was problematic. Now it's back to normal in a sense. Answer your question? Does that answer your question?
Yes. So what about people that had the lapse? Are they not penalizing people if they had a lapse in their employment?
Excellent. That's a good question. Whoever asked that question. Free lunch. Okay. So we've had situations with our clients today, right, that they were working 25 years on the job, and then recently, the strike of COVID, they were quote unquote furloughed, a month, 60 days, 90 days. If they are currently still furloughed, they will probably not be able to qualify for a home loan. That's number one. Number two, if they're back on the job, even 1 day on the job, as long as their HR or their manager can put in writing that he is back full-time as an employee of this company, despite the 2 or 3 month gap, and it's in the same company, similar or the same job, you're good to go. Now, let me take that one step further. Let's say that they didn't go back to the same job, or maybe they didn't go back to the exact same company. They went to another company, but similar job because it was a better opportunity. They found it or they found them, still good to go. As long as someone can verify with a pay stub and a letter during the processing period that they are back in full-time employment and the probability of continued employment is high, good to go.
Very cool.
Thanks so much.
So what about, timelines? So, I mean, I know I always have the agents call the lender to see and make sure, regarding appraisal timelines, closing in 30 days.
Yep.
How are you guys seeing to be able to meet 30-day or less closings?
So I had to disappear for a second. I knew Stephanie was going to ask me that question. Timelines. And I printed this like an hour before. So, as I said in an earlier slide, 30 days close of escrow or less, not a problem. 30 days is the average. We can deliver 30 days all day long, on time, all day long. 45 days obviously is better. It's a good thing, but 30 days around there is the average. Now, let me break that down for you. For example, right now, underwriting for us, from the moment it touches the underwriting's queue or the desk, it's 2 days or 1, depending on the product that we're using. So that's pretty short, back to almost normal. Upon signing of closing disclosures, most of you are familiar who've done transaction. Once you get closing disclosure, you got to wait 3 days by law before you can get any loan docs. But with us, we still have to abide by the 3 days, but we can get docs on the 3rd day of the expiration date of that. I'm sorry, clear to close, not docs. Docs was prior. After the 3 days of signing loan docs, during the 3rd day of that 3-day requirement, we can get the clear to close issued because we still have to verify funds and a few other documents, and close pretty much on the 3rd day, provided that the funds were wired in the morning and before 1 o'clock, a few hours before the 1 o'clock wire transfer cutoff. We could probably fund it same day on that 3rd day. Now, is it better the following day after that 3 days, which meaning the 4th day? Of course, but if needed, provided they wire, it can happen. So for me, I've had a couple of situations like that. So what I did is I signed them on Friday, Saturday, Monday, Tuesday. Technically, Wednesday would be the better day to fund and then position for recording. But I had him wire the money on Friday as well. I did the verification of funds and the BVOE on Monday. So come Tuesday, and the money was already there. Everything was verified. Everything was done. My funding department was able to fund on Tuesday. If you need that extra day or that extra time. 1 day for docs, 2 days for funding, 1 day, again, here it's the same day if we wire the money in the beginning. Hope that answers the question.
Yeah, no, that's awesome. So we are able to close. So I don't know if you addressed it in your, I apologize.
Okay.
What are the benefits, because you guys are a direct lender.
Yes.
So can you share with them the benefits of having a direct lender?
Sure. Requires some hand description. So I'm gonna start first of all with the, well, oh yeah, sorry. See, told you.
We can really see ya.
I told you I need guidance. Okay, here I am. So I'm going to start first of all with the smallest of the echelon of lenders. What we call it, the mom and pop broker, the small brokerage, maybe 2 or 3, maybe 10 people tops in the support staff, a few agents in there. That's your mortgage broker. And they are, by definition and by practice, they are a middle person. So they take a client, buyer, and then package the deal, and they ship it off to a lender like myself, for example, in that formula to fund and close. That's a mortgage broker, mom and pop broker. Then in the middle, you've got a few layers of mortgage bankers or direct lenders. And it's determined by their size and their volume. Now, if you remember in my second or third slide, the rankings, UWM being number 1, us being number 15, those are the different tiers of mortgage bankers depending on their size and funding history and staffing. UWM is huge, they're nationwide, and you saw the volume. We are probably somewhere in the middle as far as the model is concerned. But what's ironic is even though we're in the middle of size-wise, our volume far outruns our size in staffing and support staff. And then right here, another direct lender, which is your mortgage, your banks, institutional lenders, Chase, BOA, I don't know, who else? Citibank. The difference here in the middle section, which is the mortgage bank, is the clients have direct conversation and contact with their lender. When you go to institutional lender, you probably have first contact with the loan officer. After that, you are passed on to their support system, and direct contact and feedback becomes very difficult and challenging because that model is designed to just keep taking applications and passing it off. Versus here, I actually oversee my own pipeline, my own applications from start to finish. I have people in the back supporting me to make it happen, but I have my hands in that till still until it closes. Versus a big bank, take the app, go. Take the app, go. And that's really the model they're designed. Will they try to help you? Of course. But the model is designed to just, it's like herding the applications through. I hope that explains.
So yeah, no, that was awesome. So what is one of your most popular products at?
God, this lady gets a free dinner or something like that. These questions are crazy amazing. I forgot all about it. So at House America Financial, another tidbit, another talking point you can use when you want to discuss why you use us. A lot of, I'm going to start with the scenario I just talked about, the big institutional banks, B of A, Citibank. So what they do to get their money, it's okay, let me back up. They will fund a loan, let's just use a hypothetical example, a $100,000 mortgage loan. They will fund that with their money, and then they will do about 100 of those, package them all up, and sell them to the secondary market, which is Fannie Mae and Freddie Mac. You might have heard of that before. That's their model. In our world, mortgage bankers, depending on your size, your funding, your liquidity, you can fund the loan in your money, with your own money, but then you have to sell it to an intermediary, like something like Flagstar Bank, something like Ameri Fund. These guys will buy these loans from mortgage banks. This might get too complicated. I'll try to keep it simple. And then eventually will package it in big bulk to sell it to the secondary. Mortgage banks, so smaller and mid-sized, do not have that ability to package bulk loans and sell it. They have to do it one at a time, 5 at a time, 10 at a time. Now, if you have a good track record, a good history in funding volume-wise and quality of loans, you can apply to Fannie Mae and Freddie Mac directly, and I'll tie this in for you in a second. That's why this is good, and sell your loans directly to them and not to this people or these people. And why is that good, Jojo? You ask, because the pricing is phenomenal. Today, I looked at another lender's pricing at 3%. They had to charge 1 point to the client, versus my pricing was at 2.875. It's 0 points to the client. Now, that's amazing. To tell you, if you don't understand how amazing that is, I can beat up most lenders today on that pricing alone. Even if I'm the worst person, well, no, I shouldn't say that, but even if I have no client service experience, that alone is enough to attract buyers. But that is the big difference, because it's called, we are Fannie Mae Retained Direct. So once I package your loan, close it, sell it to them, because there's no middleman in the middle, adding another cost to it, it translates directly to your client.
Very cool. Yeah, well, I love this stuff. So let me ask you a question. We basically have free money now, right?
Yes.
Are people still buying down their rates?
God, how many more dinners do I got to buy? Another good talking point today. So I quoted you today 2.875 conventional product, 30-year fixed with 0 points. Because the rate is so cheap, I would tell you and your clients, say, look, tell your client to pay half a point or 1 point and get it down to 2.625 or 2.5.
Wow.
Now you're really getting free money. One trend that's happening today with people with a lot of equity, you heard about reverse mortgages, obviously, when people pull the equity out and do whatever they want to do with it. People with zero balance or nominal balance are refinancing to 2.5 to 2 or 3% rates, taking that money, and guess what they're doing with it? They're investing it in the equities market. Because especially when we had the plunge, stocks and equities were sort of at a discount. A lot of people pulled money and invested in stocks and bonds. And they're still doing so, because at 3%, if you can get a return on an average return on portfolio of stocks and bonds of 8 or 9% minus 3, you're practically a bank. You're making 5% on your money on top of that.
Wow.
So that's another trend for people with lots of equity or can afford to do so or do that kind of a hedging.
Interesting. So I have another question.
Jesus.
Sorry.
Go ahead.
So are they still doing, because when we first got into the COVID mess, right, they stopped doing cash out refis.
Yes.
Are cash out refis happening now, or are they?
I don't have enough money for dinner. Cash out refis are back, guys. 75% of the value you can cash out. Some will allow you up to 80% with a slight change in the pricing. It's slight. It's not enough to kill the deal, but you can go up to 80%. But yes, cash out refis are back. Home equity loans stopped at the beginning of COVID, because back then we were able to do, let's just say, an 80% loan and then a 10% home equity line of credit. So you only had to put 10% down or 20% 80% loan, 10% line of credit. That's what I just said, meaning you didn't have to pay PMI. That's what I was trying to get at. That stopped at COVID. It's back again. You can do standalone home equity lines of credit if you want to pull money out of your equity, or you can do it as a combined combo first and second to avoid PMI or to minimize your down payment.
Okay, cool. So that addresses the question, right? Is there PMI in the 3 or 5% conventional, since it's not the 20%?
Yes, there is. Every time you go above 20%, unless you can mitigate it with a second lien or a line of credit or a home equity loan, you will pay PMI. The costs are about the same between an FHA loan and a 97%, 3% down loan. No, I'm not going to tell you that secret. I'll save it for the next class. I do have a secret for that on how to help your clients not have PMI.
All right, cool.
There's many.
So I guess one other question, then we can bid adieu unless something else comes up. What is the loan limit again, going from conventional to jumbo?
Of course, you would ask that question.
Is it 763?
725, I believe. So forgive me, I'm not.
Sorry.
I don't have it that one. I had everything else on top of my head except for that one. So I think it's 725 FHA, and it's 650 or 675 for conventional. By the way, FHA limits are a lot higher than conventional always because it is designed to help the middle class and the lower middle class get into a home. So they will always have higher limits, especially in LA County. But yeah, but it touches. There's also the high balance that allows you to get a loan, higher loan amount without touching the jumbo. Typically, a jumbo, in my perspective, is about 800 and up, but I don't have those exact numbers. Forgive me. I will have them next time we talk or when I see you guys in person. Thanks, Stephanie.
Sorry. Okay, I think I'm plumb out.
All right.
And I don't see any more questions here.
Okay.
Let me see.
I don't think there are any.
Hey guys, how are you? Let's see. Some people got on here. Okay, so it says,
Oh, God. Okay, that's a good one. I have a lot of first-time buyers, but some does not have good down payment or some does not have good tax return credit. Is your program open for them? Okay. So that's 2 questions, 3 questions, and 1. First-time buyer that does not have down payment. So back before COVID, we had what we call the Cal HAFA loan, Cal HFA. And basically what that did is all you had to have was 1% of the purchase price, and they would finance 99% of the purchase price. And even that 1%, you could have gotten it as a gift too from a relative. So you can almost practically get it as 100%. The rates were 3.25%, excuse me. It was funded by California Housing Authority, and it was there before COVID. They stopped it, but it's coming back around again. So in the next 30 days or so, it'll be here. If you don't have good tax return, I'll answer that question. So you can get the non-QM loans I talked about earlier with either bank statements or pure unstated. But the challenge there on those products is they require a higher down payment, 20%. So it will always be a play between down payment and income. That's always what we see. Let's see, credit. Good question. Before COVID, we can go all the way down to 580. Now that there's COVID, the minimum credit score required is 660. Do I foresee that going back to 640, 620, 580? Absolutely, especially on the FHA programs. I hope that answered the question. Okay. Well, guys, I appreciate you being with me this afternoon. I know you're very busy. I know you have lots of options out there. But hey, I'd like to be considered as one of your options. When I meet you one day soon in person, I'd love to have a sit down and talk with you and just say how your business is doing. I will always do my best to help you find another transaction, if not more. That is my goal versus just asking you for a loan. Have a good afternoon.
Thank you.
Thank you, guys.
Recording